Hello, Steve Lentz here with Discover Options, and welcome to this edition of the Market Reports. Today, we will go over the S&P 500 Condor Butterfly Timing Report, as well as the S&P 500 Directional Likelihood Report. This is for Friday, September 2nd, getting ready for the opening of Tuesday, September 6th. All right, before we get started, I'd like to give you the opportunity to get a free ebook, Simple Steps to Options Trading Success. To do that, click on the link in the top right. Of course, we would also appreciate if you would subscribe to this, get alerted whenever we come out with a new set of market reports. You can do that by clicking on the button below. We have two reports for you today. First, the Condor and Butterfly Timing Report. Then we'll get to the Likelihood Report after this. The Butterfly and Condor Timing Report is for advanced options traders looking to find that extra edge in terms of timing the entry of the Condors and Butterflies. I'm going to go over with you quickly the reason why we look at this report, the methodology behind it, and then we'll take a look at Friday's market condition and what the edge level is going into Tuesday. All right. Happy Labor Day, by the way, everyone. Here's why. When you have a channeling market or something that looks like a channeling market, it doesn't necessarily mean that the future holds that you're going to have a channeling market continually into the future. In this case, we ran this particular market condition at the end of December 2015 through our algorithms and came up with this. There was a negative edge for doing condors and butters, a minus 4.2% edge. Now what that meant was that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. All right, and so going into that, there was a negative edge. Indeed, in that particular case, the market got very volatile on the downside. It would have been very rough sailing for any condor or butterfly trader. So that's why we look at this. It can really make a difference and give you an edge. In this case, it would have helped you stay out of the market at that critical time. Here's the current condition as of Friday the 2nd. Thursday was a downswing day, and then Friday was an upswing day with higher highs and higher lows. We're above the 50-day simple moving average, and in the world of the 15-3 stochastic, we are between 25 and 65. I think the value was at like 44. All right, and we're above the moving average just slightly. So we're going to just call this condition, we're between 25 and 65. We're above the moving average, and so altogether, we have a unique market condition. This exact condition as is described on the right side there, a downswing day, then an upswing day, above the 50, between 25 and 65 on the stochastic, above the moving average, the 3-period moving average. That's only occurred roughly 31 times in the past, going back to January of 2000. It's hard to believe, but it's true. And you can see on the chart here, we've highlighted that bar and given it a little diamond. And when you go back in the past and look and find all the bars that happen to, to comply with this definition, only 31 times in the past has this occurred. So we're going to look at those 31 times and just see if it's good for selling condors or butters. So let's go now. Here's the question. Is this current condition, as I described, a good one for selling option premium through range trading, condors and butterflies? That's what we're going to answer. So here's how we do this. We observe how much the market actually moves from a given close, and that I'm going to define that as actual volatility, and I'm going to describe that. Then we observe what market move is predicted by the option prices. That's called implied volatility. I'm going to explain that. Then we're going to compare the two together and label the bars favorable or unfavorable for selling premium through range trading. So let's go initially to the methodology of the actual volatility, the actual move. You can take a given close and then go forward 21 days and observe how much the market moves, either up or down. In this case, it moved a total of 50 points from that close, and that's roughly 2.4% of a down move. We then label that in the little actual volatility indicator at the bottom there. And so we take note of that. That's 2.4%. Here's the question, though, for butters and condor traders. what market move was being implied by the option prices at that time of April 28th or so. Well, when you go back and look, the VIX was implying a move of 4.4%. 4.4%. That was more than what actually came about at 2.4. So in that case, we would label that bar favorable and we would paint it the color blue. And in fact, all the bars that turned out to have been favorable we'll paint blue. Those where the actual move was more than the implied move, we're going to label those bars red or unfavorable. All right, so we go back in time, and we can go back in time and look at all of those bars, and we can ask ourselves what percentage of the bars were favorable, going back in time to January of 2000, say. All right, once we have that benchmark percentage that were favorable, we're going to then look at our current condition and ask what percentage of those 31 I talked about that match our current condition, what percentage of those were favorable? All right, I hope you agree that if the market moves less than what was being implied, that's a favorable condition in hindsight, right? Okay, so we're going to compare these two percentages. In this case, when we go back and look at all the closes going back to Jan of 2000, all 4,200 of them, 64.7% turned out to have been favorable in hindsight. Right, 35.3 were unfavorable in hindsight, where the market move was more than implied. So that is our benchmark understanding, all right, of the market conditions for favorableness for selling condors and butters. Now, of the bars that match our current market condition, like I described earlier, what percentage of those 31 were historically favorable for selling premium? Turns out most of those were certainly favorable. In this case, 77.4% of those 31 ended up being blue bars when you go back all the way to Jan of 2000. Now that 77 is more than the benchmark 64.7. All right, and that means then that we have a 12.7% edge. The current market condition historically has resulted in a greater percentage being favorable than just the random historical benchmark. Does that make sense? All right, so the conclusion is that there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So that's it for the Condor Butterfly Timing Report. It would appear that as of the close on Friday that we have a higher than usual likelihood that it's going to work out to be a favorable bar in hindsight. Okay, so that'll hopefully help you, folks that trade butters and condors. Now 31's not that much of a population. I like to have 50 to 100 or so, or even more. And some of the conditions we've run into do give us more of a population to look at. But it is what it is. Treat it with that caveat in mind. Only 31, but I think that there's a clear, at least a clear edge here that we can see. Let's take a look at the market likelihood report. Before that, though, I want to make sure you understand that at Discover Options, we offer one-on-one mentoring services that are outstanding. We have professional option traders that will mentor you, hold your hand, and take you through the process of going from even a beginning trader, intermediate, up to an advanced options trader. We have money managers that get with us, and they need refinement in their approaches. We really have a wonderful program here going from the beginner all the way up to the advanced. The equity track is a complete 14-unit curriculum to get you to an advanced level in as quick a way as possible. Futures track, of course, is for futures options traders, and it's just a wonderful thing. Go to discoveroptions.com, give us a call at that number there. We'd love to talk to you. Even if you want a custom curriculum, we could work that out for you as well. All right, now let's go on to the market likelihood report. This is where we take a look at our current condition and we ask ourselves this question. Since Jan of 2000, how often has this same condition occurred? We already know that 31 times. And what direction did the market go? we're going to see if of those 31, did it result typically in a bullish direction, bearish direction, or maybe a market neutral, more volatility or less volatility. So we're going to do that now. Now here's how we do this. We first understand the historical distribution of price. Remember, before the previous report, we looked at the historical distribution of volatility. Now we're going to look at the historical distribution of price. Then we're going to understand what price does after our condition develops. Okay, that's 31 times. Then we're going to see if there's an edge when we compare the two. So here we go. How do we determine the historical distribution? Here's the methodology I came up with. Backing up, some people would just take a look at those 31 and look ahead 10 days, 5 days, and ask, how much on average the price was above or below the close. That'd be one way of doing it. That would be one way of doing it. But what we wanted to do was drill down further and get a clearer picture of bias and distribution of price. And here's how we do it. We measured the distribution by observing how often price from any given close touches a 1 standard deviation volatility band that's placed from each bar's closing price. Okay, 5, 10, and 15-day bands. They're measured 1 standard deviation from the close. I used 20-day historical volatility numbers, or a statistical volatility input, to determine the width of those bands, and these are log normally distributed. Here's an example. Let's take a close here, and we have a band on the upside and the downside. This is a 10-day band set up above and below the current close. And the question is over the course of 10 trading days, is price going to go up and hit that upper band, go down and hit the lower band, or wobble in the middle? Now look carefully. Over the course of the next day or two, it went up and hit that upper band. You see that? See the upper band? Well, the next day it hit it. So in that particular case, it hit the upper band. And that goes in the database for our statistical calculations. Now, look at the close there, right, let's say on the 23rd or so of October. I've drawn the bands above and below, and the question here is, for this close, in hindsight, did price go up and hit the upper band, the lower band, or wobble in the middle? And there it is. Again, I'll go back. Let's see if it went down and hit that lower band. It certainly didn't hit the upper band, but it did kind of come close to hitting the lower band, close but no cigar. So in this case, it hit neither of those bands, and that's what goes in the database. It hit neither of them. So here's what we do. From every close, all 4,200 or so, going back to Jan of 2000, we record how often price struck the upper and the lower 5, 10, and 15-day bands. That's 6 bands. We're going to measure how often it hit each of those 6 bands. That gives us a good bead on the historical distribution of price. So here's the statistics through Friday, September 2nd. Of those 4,212 occurrences, price struck the upper 5-day band 29.4% of the time, almost 30% of the time. It hit the upper 10-day band 23% of the time, the upper 15-day band 23%. Then let's go to the lower bands. It hit the lower 5-day band almost 30%, the lower 10-day band almost 30%. It hit the lower 15-day band 32.4%. See that? So that's the benchmark historical distribution of price. Just random historical distribution over 4,212 occurrences. That's our benchmark. Now, if we have an amazing bullish signal flashing, let's say it is just the grand treasure everyone's been looking for, the perfect indicator. All right. And so if that occurs, what do you think these statistics would say in the case of the perfect condition? Well, if it's bullish, the perfect condition would result in all 3 of the upper bands getting struck 100% of the time, and all 3 of the lower bands getting struck 0% of the time. You see that? And so what we want to do is just go and take a look at what happened when that condition. So we want to understand now the distribution after our condition develops, which is what it is here. Now we're not only going to look at the statistics as of the close on Friday. I'm going to go back to those 31 incidences, and I'm going to look at what happened when price happened to go above the high, the previous day's high. So that means that if Tuesday price goes above Friday's high, I want to understand what the historical distribution was in case that the previous bar's high gets taken out, as well as the low. If price goes below Friday's low, I want to know what the distribution historically was in that case. So that way it'll help us get ready for Tuesday's action, okay? That's what we're doing here. So let's go take a look. As of the close on Friday, here's the distribution over 32 occurrences. Take a look at that. If as of the close on Friday, just looking forward to those 32, looking at those 32 occurrences, of those 32 occurrences, price struck the upper band 25% of the time, which is less than the random historical one of 29.6. You see that? Let me get my little marker and I'll just kind of take some liberties here. All right. All right, good. All right. So here we are. Price struck, of those 32 occurrences, price struck the upper 10-day band 21.9, which is a little bit less than historical. It struck the upper 15-day band 18.8% of the time, which is less. Okay. It also struck the lower bands less often, by quite a bit more margin on the upside. So if you look at this, you could conclude that it's striking the lower bands far less often. Even though it is striking the upper bands less often, it's striking the lower bands to a greater degree less often. And so you would bias this this is a picture of lower volatility with some bullish bias going on here. That's what this is a picture of. Now, let's go and take a look at, let's see, is this going to let me go to the next slide? No, it's not. So what do I do here? Click, boom. I can click escape. There we go. Okay, now if price goes above the high of Friday, take a look at these differences. It's hitting all 6 of the bands less often. This is a picture of lower volatility. It's hitting the lower bands to less often to a greater degree than the upper bands. So again, we have some bullish bias here. Now, if it goes below the low of Friday, look at that. Only one occurrence out of those 32. It only happened one time out of those 32. Looks like there were a number of inside bars where it went above or below neither of the high or low. Okay, so we're going to ignore the single occurrence and focus on the other one instead. So this is a picture of lower volatility with a slight bullish bias. Now, what I like to do, instead of using statistical volatility to determine where these bands are, I also like to use the VIX, which is coming from the options market, and I like to divide it up between an upside VIX and a downside VIX. An upside VIX and a downside VIX, so that the VIX in general is typically higher than statistical volatility, so the bands are going to be in general farther apart. They're going to get struck less often in general, and that's what you can see here is a picture of the bands getting struck less often. Come on, let me get my mouse here. The upper bands are getting struck, 22, 16, 15. Lower bands getting struck 17, 18, and 20 or so. This is less often than the SV bands, statistical bands. But remember, the upside band, I'm using a lower volatility number than the downside bands. I'm using the skew adjusted VIX to determine this. Even still, all 6 of the bands are getting struck less often, with the downside bands getting struck less often to a greater degree. And then, let's go to the other one. Oops, timeout. It's skipping here. There we go. If price goes above the high of Friday, we have a similar situation. The bands are all getting struck less often with a greater degree on the downside getting struck less often. So again, slight bullish bias. and then on the only one occurrence that we're going to ignore if it goes below the low. So all in all, I think you can see that we have, oh, wait a minute, where am I? Boom, boom. Oh, I skipped around. There we go. Oh, there we go. I'm sorry about that. Here's the skew adjusted VIX, only one occurrence. But here we go. We have just a general picture of lower volatility. And the lower bands here, well, except for that lower 15, it gets actually struck slightly more often on there. That could be due to a variance in terms of the occurrences occurring. But generally, you see the picture here. Lower volatility, slight bias on the upside. Look at that. Of those 27 occurrences on the VIX bands, never did it strike the lower 5-day band. Very interesting there. Here's where the volatility is carved up. Our statistical volatility of the last 20 days, 7.6. The downside adjusted, skew adjusted VIX is at 13.7. Let's keep that number in mind as we now examine a trading idea. If you are bullish at all and you like to sell premium and you're a condor butterfly trader, here's an idea that we like to toss out every now and then. This is called a hedged bull put spread. What we do is we take that downside VIX, skew adjusted VIX, plug it into option view, and then that draws the 1 standard deviation border right there. We're going to do a bear put spread right at the money, just a single lot, and then we come out 1 standard deviation to the first strike after the first standard deviation. We do a 5 lot at 20 points, and that gives us then a net credit. No matter how much the market goes up, the money coming in here is more than paying for this little downside hedge. All right, and so when we analyze this, we get a picture that looks just like this. We're going to make 5% on our money in the course of a month if the market goes up. If the market goes down, we're going to get rewarded with upwards of 3 times what we can make on the upside if at expiration the market ends up higher than the 1 standard deviation level to the downside. Now, if it does go down through our short strike, it would appear we would lose roughly the same amount we're trying to make, 17% on that if it goes down and we finish on the downside but above 1 standard deviation. That's 17%. So that's a good picture. When you look at the price chart, you can see the green area is quite substantial. All we need is for the market to channel around a little bit or go up, and for us to be bullish but not be so wrong that it goes way, way down like that. So I think we have a real good, interesting trade idea here. That's it for this likelihood report. Hopefully this has been helpful, and we'll look for you next week at this same bat time, same bat channel over the weekend. I'm Steve Lentz with Discover Options. We'd love to hear from you and for you to subscribe as well. Take care. Bye-bye.